Ladies and gentlemen, welcome to the Maverick Mindset Radio Show. I am Adam Williams.
And I'm Ashley Muckenhop.
And this is the radio show for the dreamers and doers. It's for those who are willing to step into the arena.
Some call us the crazy ones, the misfits, the rebels, the troublemakers.
We don't accept the status quo. We leave the world better than we find it.
We approach each day with an enthusiasm unknown to mankind. We maintain irrational optimism about the future.
This is the Maverick Mindset Radio Show, brought to you by me, Adam Williams.
You didn't mess up this time.
I didn't. Although I almost did, because I am so distracted.
I know.
I'm so distracted. First of all, someone moved this table 6 inches and didn't tell me. And my whole, I think it was that curtain behind us that moved. And then there's the construction going on outside. And I'm like frustrated because they have a lot of the roads torn up, which
yes.
I get it. At least our tax dollars appear to be doing something. But then there's nowhere to park.
Nowhere.
And then Public Works has 2 trucks parked sideways up around Perry Square. So, Mayor, Public Works, do better, be considerate, you jerks. Yeah, I went there. All right.
Well,
good morning.
It's
good morning. You know what it is? You know what else it is? We're talking tax stuff today.
So you're fired up.
And yeah. All I can think about is what this is costing us for them to occupy parking spaces so that I'm running into this radio show, and what it's going to cost us to. The announcement yesterday was we're ramping up our intelligence and spying on Greenland. Greenland. We're ramping it up because that's worth it.
What's happening in Greenland?
Well, there's resources there apparently, and of course Trump's ego is playing into it, and maybe it's a strategic play that if we can get Greenland, then we can get Canada next. And I'm on eBay. I'm shopping for islands because I'm starting my own country. I am so sick of this. Show 53.
Yep, we're back.
And we have a guest today.
Favorite guest. Yep.
Our favorite guest.
Mm-hmm. I'm excited.
I am excited too. So we're talking taxes today. We're talking tax strategy. So demystifying tax strategy. Yeah.
Yeah.
Building a future in wealth, not costing your future in wealth, with special guest Jackie Williams. Welcome to the show.
Thank you for having me.
The tax.
We're excited to have you today. I was thinking about that this morning. Like, it's May 7th. Nobody's thinking about taxes right now.
No.
Except the people who don't pay a lot of taxes because they're working on it. They just filed a couple weeks ago, or maybe they're on extension and they're wrapping things up. But
wait, so you're saying the people who don't pay a lot in taxes aren't thinking about it?
Well, the high income earners who don't pay a lot of taxes, right? The millionaires and billionaires who don't pay their fair share. Well, the reason that they pay less is because on May 7th, they're thinking about May 7th, 2025, they're thinking about their 2025 taxes that they're going to pay in April of 2026.
Yeah. But also the people that pay too much might be thinking about their taxes.
Yeah, they're
too.
feeling the pain.
Yeah, they're trying to find the money. Yeah. So that's why we're here today. Perfect timing for everybody. Yeah. But before we jump into everything, as always, blowing your minds every Wednesday at 9, going live at 9:05, streaming live, Maverick Mindset Radio on Facebook. You can also find us on Spotify and Apple iTunes podcasts. We got the episode streaming live on YouTube, and you can always find more information at maverickmindsetradio.com. Oh, wow. I just scrolled down to the quote of the day, which I hadn't looked at until that moment.
Oh, nice.
And I either primed it really well or I stole your thunder.
You probably stole my thunder.
So what is our quote of the day today, Ashley?
Okay. If you're only thinking about taxes in April, you're doing it wrong. The IRS has a plan for your money. Tax strategy means you do too.
The IRS has a plan for your money.
Yeah.
Yeah. And guess what? It's not a super helpful, beneficial plan for most of us.
No.
It's $1 trillion military budget. It's spying on Greenland. It's billions and billions and billions of dollars to Harvard and Columbia and Cornell and Northwestern. I didn't know that was a thing. I didn't know the federal government. I am so enraged right now. I didn't know the federal government gave billions of dollars to these universities. So like Columbia University, that's New York City, right? Like that.
Yes.
I haven't looked it up, but I'm going to imagine their tuition is $40,000 or $50,000 or $60,000 a year, and the federal government gives them billions with a B to do research, and we have this student loan crisis, and it's driving me crazy. So the IRS has a plan for your money, and it ain't a good one. And we're here today to talk about your plan for your money.
Right. You should have a plan too.
So that they're not
kind of flip the the tables on the IRS?
I will flip the tables on the IRS. Or
that's the next T-shirt.
You know what I need to. You know what I need to pull up is I haven't talked about it on the show, but I used a prompt in ChatGPT where I said, "You're my drunk bestie," and you hear someone at a cocktail party asking me what I do, and you decide to interrupt. I should read that on this show.
But, that was a good one.
But one of the lines from that is, "And they make the IRS your financial chew toy." It's really good.
So where did that quote come from?
ChatGPT.
Really?
Yes.
Okay.
Yeah, she makes she brings quote of the day, but it's not attributed to anybody.
Yeah,
it's just what ChatGPT puts together.
Okay. They give me some good ones.
So that quote is from Ashley Muckenhop.
Interesting. Yeah. Via ChatGPT.
Yeah, I put in that I need a good quote on tax strategy and planning, and they spit me out beautiful things.
Okay.
All right. So today, broadly, what are we doing today, Ashley? What was the idea behind this show? And
the idea is almost like tax strategy 101, right? So under the questions that people that are tax planning are bringing their tax strategists, but also the questions of, do I even qualify for tax strategy? What is it?
Yep.
How does that benefit me? So we're going through answering those questions and explaining what it is and how it benefits you.
So let me tell a story so this resonates.
Okay.
So when we travel, typically out of Erie, there's a local limousine company, Rep Limo, love you guys, that we have drive us to the airport. And I think there are people that will hear that and be like, "Oh, limo to the airport, blah, blah, blah," which is a whole other mindset issue that we can get into. And it's not a limo. It's usually an SUV or a sedan or whatever, depending on how we're going. But the cool thing about this is, for the price that you pay, they're sitting waiting at your house when you need to get to the airport. And if you have one of these 6 a.m. flights out of Erie, they help you put your luggage in your car, your kids get in, and they drop you right at the front door of the airport, and you're on your way. And it turns out, if you're gone for probably 5 or 6 days, the cost is about the same.
As parking.
To be driven to the airport, right? So this was one of those things where it's like, I don't need a driver to take me to the airport. I can drive myself to the airport, and I can pay for parking and lug my luggage, through the snow, because it's always snowing here and it's rained for 19 straight days. And I can do this. And then I did it once, and it was like, oh, no, this is for me. And tax strategy is kind of the same thing. There are people out there that think, well, I don't need that. Yeah. Right? I'm not at that level.
Yeah.
And I think that's one of the things that we're going to talk about today is, no, there is a broader appeal to this. Now, if you're not making a ton of money, you don't need a ton of tax strategy. But if you're making, the more money you make and the more your business grows and the more your income goes up, there's more work to be done here. So I think a good starting point, because I think what we're going to do is we're going to talk about some of the really common questions that we get from people. Because we've been on the road a lot, we've been booking a lot of calls, been doing a lot of events, and we're getting a lot of we get common questions from people. So I think that's what we want to go over today, since we have Jackie in the studio.
Sounds good.
Anything else you'd like to say before we jump into things?
No, let's shoot.
What's that?
Let's shoot. Let's go.
Shoot. All right. So I think the first thing is just being clear about what tax strategy actually is, right? I think a lot of people just learning that this is a thing are like, oh, all right, this is way more interesting than I thought it was, right? So tax strategy I would compare to tax preparation or tax filing. So most people sit down, let's call it April 15th, and they have some forms filled out and they report on what happened historically, and then they either owe the money to the IRS or they get a refund back because they've had some withholdings or they've made some estimated payments or anything like that. So it's very reactive, right? And it's reporting historically. Tax strategy is taking a proactive approach to managing your taxes. It's looking forward and not just looking backwards. So generally, we're looking for, legal deductions that you can take and expenses and credits and other ways to pull money out of your business in tax advantaged ways.
Right.
Take the money out that you're not going to get hit with a big tax bill, but also building wealth and protecting your financial future. And generally speaking, there's more opportunities to do this if you are a business owner, or if you have entrepreneurial aspirations, or if you have a side hustle. But it's not just for business owners. Like high-income W-2 earners and 1099 contractors can do this as well. So that's just kind of an introduction. Is in the tax code, there's tens of thousands of pages of laws and guidance and rules and things that they want you to do and don't want you to do. And many of those things are designed for business owners, but a lot of people don't know. right? There's strategies and tactics out there that, unless you've read through this stuff, unless you've studied this stuff, and unless you're being proactive as opposed to reactive, you're going to miss out on this. So that's what we're talking about today. Okay?
Okay.
All right, where do you want to kick it off, Ashley?
Let's do the reasons so we did the top 8 reasons that people seek out a tax strategist. So who are the people that are seeking out a tax strategist? Why are they seeking them out?
Yeah.
I always ask that, like when I'm on a call with someone, is what happened that you all of a sudden said, I think I need tax strategy?
Yeah. So there's people who explain what I just explained about what tax strategy is, right? And that piece of education is usually enough to trigger people reaching out or raising their hand and saying they're interested. But I think one of the first things that we hear, Jackie, is that there's either like bad communication or no communication, or I never hear from my person, or like if I take them a question, I may or may not get a response to it, but that's the extent of my communication with my CPA, as opposed to a good strategist, which is going to schedule meetings in advance, at least quarterly, likely monthly. Right? So
what we're talking about is reasons that people come to us because they're upset with their accountants, really. I mean, these are the reasons we see, right? Mm-hmm. So if you are working with, I think some of this sounds like, they don't know what type of accountant they have. Mm-hmm. They have, in what we're talking about here is, you're saying bad communication. Do they have just a tax preparer? Are they signed up for tax strategy services? So I guess the first reason is bad communication. So,
and I wanted to ask you, because I get that question on the phone all the time. Why is my accountant not telling me this? Why are you different than my accountant? Why aren't they telling? And I'm like, oh, well, again, what type of accountant do you have? Who are you using? So that's a big...
And there's reasons why you don't hear about this stuff from your accountant. One of the reasons is the industry is just very broken. It's designed for people to dump information on their tax preparer in that first quarter, and the preparer fills out the forms, and they've got a crushing deadline approaching them, and they get it done and say, here you go, and that's it. And then the accountant takes a vacation because they need to. I think the other part of it is there's a lack of education on the client side, that they don't know that they can be proactive about this stuff. There are strategies and opportunities out there that you can be looking at now. The third piece is, as a rule, I think accountants are very risk averse, and they perceive some of these strategies as risky. Now, they don't actually know what that risk is, and they can't articulate it, but it's perceived as risky, and that's sort of the understanding. And then I think the fourth piece is, there are also accountants that just don't know about this stuff.
That's what I was wondering. Like, what?
Well, I mean, we, even just getting prep done, this year we've worked with a variety of accountants to just, start the file, right? And then we review the file and improve the tax return. And there's a lot of things they don't know about, but also I think when you think about it, they're just trying to get it done. This industry has become such a compliance and squeeze it into the time frame. And honestly, the clients don't even know what they're looking at when they look at the tax return.
Yeah.
I can't tell you how many people put blind faith in their preparer to just get it done because they don't understand what's on the tax return. So I think tax strategy, to kind of bring it back, tax strategy is about planning, but it's also about understanding how much you're going to pay, why you're paying that much. And maybe we don't need to get into the nitty gritty of this is the schedule it's going to be on and this is where you see it. But when you work with a tax strategist, they should be able to look at the tax return and see that you got that deduction or you got that credit. And, you can rest assured that what you planned for is actually in your tax return. Yep.
Yeah. And I think, I think another thing that we hear a lot from people is that their CPA or their accountant is retiring, and that for them is a good opportunity to make a switch. People don't feel good firing people, especially if you're not really in the business of doing that. So like ending a relationship with a vendor isn't always a pleasant thing. So we do get a lot of people that reach out that they know and they're ready to make a switch, and they know that there are other opportunities out there, but there's a fear of switching, or there's a fear of ending a relationship with somebody. So we do get a lot of people that reach out to us.
Because they don't know, like I said, they don't know what's on their forms or what's missing. It's not like they could go to their account and be like, hey, you missed this, because they don't even know what's missed. So it's even harder to find
that's what's really interesting, because when you get in groups of accountants, again, they're risk averse. And when you hear them talk about filing tax returns, they talk about this thing called preparer liability, which means as a tax preparer, if you haven't done enough homework, if you haven't done enough due diligence to sort of verify the numbers on that form, you can get in trouble, right? Mm-hmm. Now, what's that actually mean? Depends on who you ask. I don't think it's the biggest deal in the world. But the point is, this is just like lawyers, right? Lawyers function so often in this realm of, I don't want to get sued for malpractice. Tax preparers say, I don't want preparer liability.
Well, it's malpractice too, yeah.
That is such a low threshold, though. We raise the standard. And we say, we're not worried about preparer liability because we want to do what's in the best interest of our clients. Right. And it turns out if we do what's in the best interest of our clients, we don't have to worry about preparer liability.
Right.
If our threshold is excellence, but the standard for liability is competence, meaning if you fall below a level of competence, you get in trouble. What we're looking at is if we fall below the level of excellence, it still better be pretty stinking good.
Yeah.
Right.
And this is just how these communities work. You go to a bar association event or you go to a CPA event and they're talking about liability and risk and getting sued for malpractice. I'm going in saying our clients love us because that's what we aim for, right? So we've kind of had to change the conversation around that again, it's accountants and professionals looking at risk and saying, I don't want to get in trouble. Versus a really good strategist is not saying, how do I stay out of trouble? They're saying, how can I do the best job for my client?
Right. So not how do I stay out of trouble, but like how do I ask the right question so you know how that you're preparing the form accurately and completely. Yeah. Not just do the bare minimum with what's been provided to you.
And I think this is one of the challenges is I don't know if it's because of the deadlines or just the way that the industry works, but another thing that we've seen from a lot of clients and potential clients recently is they learned that their accountant wasn't doing something, right? Mm-hmm. Well, I gave my accountant all of my credit card statements, so I assumed that there would be, an expense on my taxes for the interest that I'm paying on that credit card. And it turns out, I found out this year, they weren't doing that. My accountant was not taking that deduction for me that I could have taken. And then I dug in and realized they haven't done it in 3 years. So there's this assumption from the client of, well, you're doing this and you're doing it properly. But I believe there's an assumption from the tax preparers that's saying, I'm assuming that you told me what was important and gave me all the information that I needed. And there's no communication there. There's no making sure that you're all getting on the same page.
Well, and it's also like... maybe bookkeeping hasn't been done or the financial statements are handed over, assumed that the bookkeeping was done by a competent bookkeeper because that's not the service the tax preparer is providing. And then that's how things get missed too, right? So we can get into that later. And gosh, I feel like we talk about how important bookkeeping is so much. Mm-hmm. But
it's that's like the first question you asked me. Do they have bookkeeping?
Yeah. If they don't have bookkeeping, we can't do our best. Yeah. So. Yeah.
I think I've also seen with a lot of people recently that they send the information to their accountant and the accountant prepares the returns. And the client assumes, well, if you're preparing my taxes and you're missing information, you're going to ask me for it. Mm-hmm. That's the assumption. And I think on the accountant side, the assumption is, well, you've obviously given me everything that I needed, so there wouldn't be anything else out there that I'm missing, right?
That makes my blood boil.
But that's
because our folks won't do it. Like I don't tolerate that from our team.
Well, you can't tolerate it,
right?
Because your threshold, your standard is higher than competence. Your threshold is higher than negligence, mm-hmm. which is the threshold for many tax preparers. Your threshold is do what's best for the client, and usually that involves digging in and getting additional answers and asking the harder questions. And it could be the client isn't giving you everything because they don't know, or it could be the client isn't giving you everything because maybe they think it's better if they don't disclose everything to you, which is another problem. Yeah. All right, so I think what I want to...
I'm fired up now because that's the stuff that makes me mad.
Well, let's start with this then, because I think a lot of people, let's just start with the basics of if you've got a business owner or somebody on a W-2 out there, first of all, I bet they don't really even know how much they pay in taxes, right? We go through this all the time, that people are familiar with the check that they write in April, or maybe they're familiar with the quarterly checks that they write if they're business owners. If they're W-2, they have no clue because it gets withheld from their paycheck every week or 2 weeks or month.
I have a question.
Yeah.
Because you say, and I always hear people say, why do people, because I know nothing.
Yes.
I'm the person out there that knows nothing. Mm-hmm. Why do people pay quarterlies instead of just paying it? Some people say they just pay it at the end of the year. Why would you choose to be paying it quarterly too?
Well, the IRS expects it to be paid quarterly. If you're going to have something, so if you're not having withholdings done, right? So when you earn a W-2, it's being withheld throughout the year, right? So the IRS knows how much you paid last year. So they expect that you are paying on a quarterly basis, that you will pay your taxes in, okay? Everything is due on April 15th, but there is a possibility that, you know, you'd have penalties and interest if you don't pay at least the safe harbor amount on a quarterly basis.
So that, now, they want you to pay estimates of what your taxes are going to be. And if you're far off on those estimates, it costs you more money.
Right.
They charge you penalties.
And who determines your estimates?
So there's a form that is calculated, right? That calculates it, right? So there's a safe harbor where it's about.
Well, before you, I want to preface this a little bit more, because the difference is important, and this is a big one, right? Because at a smaller event I did recently, I brought this up, and everybody went, "Wait, what?" So this is a great example of paying your quarterly estimated taxes. Most people are, when they file, let's say it's April 15th, they file their annual tax returns, and then their accountant also says, here are when your quarterlies are due. And it's like, there's also a quarterly payment due that same time, right? Generally speaking. So again, the accountant goes behind the curtain, comes back out and says, here are your quarterlies. But it turns out there are two ways to calculate what estimated payments you need to make. And this is the part that drives me crazy, is because the two different ways to calculate, which I want you to explain, Jackie, the two different ways to calculate it, one of them keeps more money in your pocket throughout the year rather than giving it to the IRS on an interest-free loan.
Okay.
And if you have a fast-growing business, you need that cash. So it turns out that the way of calculating it, that second way that keeps more cash in your pocket, is actually better, in my opinion, for fast-growing businesses most of the time. But this is a perfect example of, well, my accountant told me what my estimates are. Well, how did they calculate them? Because there's two ways to do it. Did you bother to ask? Well, no, you didn't bother to ask because you didn't know that there are two ways to calculate your estimates. So do you want to give us a run through? You were talking about the safe harbor, Jackie. That for me is the second way, or the other way. But you want to explain what that means?
Right. So, the safe harbor is the concept of what you paid last year and tack on 10% and divide it by 4. Putting it simply is how much you would pay.
You're adding on 10% for the next. Okay.
Yeah, that's how much you would pay on a quarterly basis to make sure that you're not going to owe interest and penalties, and you pay it by the designated deadlines, right? This is a great opportunity if you had like a loss last year. Like, your safe harbor is very low, right? But if you think that you're going to have if you're think you're gonna have a much better year, but you want to reinvest it, you could pay the safe harbor, which would be less in tax, and then pay much later, and reinvest it in your business. Or you could, if you want to give it to Uncle Sam and not get paid interest on it, you could pay what you think a fourth of what your income is going to be.
So let's break it down. If you make $300,000, if you made $300,000 last year, you paid $100,000 of taxes, right? One way to pay your estimates is say, for this year, well, I paid $100,000 in taxes last year. Tack on 10%, divide by 4. That's my quarterly payment.
Got it.
Yep.
Now let's assume you've got a fast-growing business and your income is going to double this year, and you're going to make $600,000. And to simplify it, your tax bill would be $200,000. This is the way that most accountants do it.
Okay.
They're saying, what do you think you're going to make this year? $600,000. Oh, cool. You're going to owe $200,000 in taxes. Let's divide that by 4, and that's your quarterly payment.
Wow.
But there's the other way to do it, where you could just make estimates of $110,000. That's an extra $90,000 throughout the year. That's working capital in your business that you can deploy, which you need. If you have a fast-growing business, you need more cash to fund those operations, and that's the difference. So yeah, there's the standard way of take what you think you're going to owe, divide by 4, and pay your estimates for business owners. But there's the safe harbor that Jackie's talking about, which is take last year, tack on 10%, and that can be your estimate. And even if you owe way, way, way more money than that come April 15th, you don't have to pay the penalties and interest because they invented this safe harbor. Okay. So this is a really great example that, like, most people don't even know there's more than one way to do this. And again, if you're a W-2, you don't have a lot of control over what they take. Mm-hmm. You've got it coming out of every single paycheck that you get, and it gets sent in. And you may or may not owe at the end of the year, depending on what else is going on in your life. But So where we started this is that's what most people know, is they know the check that they write in April, or maybe they know what their estimates are, but they don't really know what their total tax bill is.
Yeah.
So I talk all the time. IRS Form 1040, page 2, line 24. It says total tax. Like that's what you paid the federal government, and then you got state and local stuff on top of that. So my piece of advice number one is look at that line. Like if you just filed a couple weeks ago on April 15th, look at that line on your 1040 to see how much you paid. And then the first question that we get after that is, well, how can I legally lower that? Mm-hmm. Right? Like what is that? What does that actually look like? This happens a lot to us. So I don't know. How do you answer a question like that? Like I know what I pay. I'm not happy with the amount. How can I legally lower my tax bill? What are some of the things I should do?
Well, so the first thing we kind of look at is how are you already spending your money, right? And what are we missing out on? And how can we document it better or transact it in a way that's legally appropriate, but also can save you on your taxes? So I think that's the first place to start. And then I think the next place that we like to talk about is what do you have coming up this year? What are you planning to do? And then how can we organize that in a way that saves you on your taxes? So, and that's like, do you need new equipment for the business? Are you starting a new business? Are you planning on doing something, personally? You have a big personal goal. How can we look at that how are you incorporating that into your business? Is there overlap that we can take advantage of increasing expenses from a business side of things, legally and appropriately, and documenting why it makes sense?
And this is also where it comes in. We talk a lot about how people need to have a good bookkeeper.
Yeah.
Right? Like you said, we start with where are you spending your money right now? Well, you can sort of kind of guess, or you can know.
Right.
And businesses that have good bookkeeping, that track their income and their expenses and categorize them properly, those tend to be the more successful, more profitable, better businesses because they have that foundation in place.
Right.
And then with that foundation, you can not only run your business better, but you can also do tax strategy and you can manage your cash flow a little bit better.
Why don't people, because there's so many people that don't, and you guys have said it's not a big cost to your business to have it. So why do people are just like, I can do it myself.
So
I got it.
It's really just undervalued. People think that it's something that shouldn't cost them anything,
yep,
and that they can do it themselves. And I will tell you that there are people that are very smart people that just haven't taken the courses in the language of business, which is accounting. So if you think of it that way, it's not just putting numbers into QuickBooks, mm-hmm, because even if you put the numbers into QuickBooks, if you don't put them in the right way, garbage in,
yep,
garbage out, and you might not even know that you're putting them in the right way. I mean,
it's not as simple as people think, right? To just, I'm going to throw it in here and get the correct stuff out of there.
Yeah.
So this is really interesting to me because I think a lot of people do their own bookkeeping. They think, well, it's all linked to my bank account and my credit card, and my QuickBooks shows everything, and it's very easy for me to do the entries, right? It's just click a couple buttons for every expense, and it's all categorized. The interesting thing is, for those businesses, say, okay, you do your own bookkeeping as a business owner. How much money do you make? Well, I don't know. Then you're a bookkeeper and you're a really bad business owner. Your job as the business owner is to know how much money you make. Yep. It's the bookkeeper's job to do those entries. If you are able to do both, great. But we're also busy. Entrepreneurs are also busy. We have so much stuff going on that it's like, okay, the books are done, and usually it's because year end is coming up, or my bank is asking for a financial statement, or I have to file my taxes, right?
Yeah.
They're usually not on top of it. We get our books in our business. Our goal is by the 3rd of the month, unless it's a weekend, then we'll extend it to the 5th. So we would know by May 5th how April went for us, right? So that Jackie and I, as the owners of the business, can review those numbers and say what worked and what didn't work.
Yep.
Versus waiting until December and categorizing expenses to get them all in there. And then at the end of the year, sitting down and saying, oh, we didn't make enough money, or we didn't make any money, or we had a loss, or no wonder there's no cash in the bank. We had all these expenses that we weren't really keeping track of. So that's a big one, is understanding your job as the owner is to know how profitable you are. Yep. And we get people that call us that say, well, I make this money, but I don't have a lot of expenses.
Yeah.
You may be surprised at how many expenses that you have, because you're not calling us because you've got so much extra money and you just don't know what to do with it. You're usually calling us because you owe a lot and you're saying, I don't even have the cash to pay this tax bill, right? So just getting a better understanding of your expenses. So that's step number one, you said, Jackie, is knowing where you spend your money right now. That comes from having good bookkeeping. And then where do you want to go with the business, and how can we implement a strategy to help with that? And I guess not just with your business, but like you said, also with your life. Like, you want to buy a vacation home, you want to buy a boat, you want to buy an apartment complex, you want to take a vacation. Let's find tax advantageous ways to do this.
Right.
So I love it. Okay. So I think another thing that we hear a lot, and I think this will be important for the listeners of our show, is how do I know if I qualify for tax strategy? How do I know if I make enough money or if my business is big enough? So what are your thoughts on that?
Well, I think anybody can apply tax planning and tax strategy. Can we take your bill all the way down to zero? Probably not. Depends on what strategies you have going on. So if you're starting out with less or not paying anything in taxes, it's probably harder to find more, right? To get you. But, definitely if you are, definitely if you're a business owner and you are netting more than $250,000 to your taxable income line, there's definitely strategies that you probably are not doing.
Yeah, that's the instance where if you're at that level, you need to be working with a professional.
Yes, yeah.
But I think even lower than that level, if you're a business owner making $50,000 or $100,000 of income,
right.
Take a look at your tax bill, see where it is. But there's always things that you can do to be looking forward, or even if you're W-2, right? Like it always used to blow my mind when I did more lawyer stuff and I would do family law, and every single year a mom and dad would fight over who gets to claim the kid on their taxes, right? That's an example of tax planning. That you could do this in advance and figure out what's going to give you the most money as a family and figure out what to do with it. So I think the point is, if you're really, really small, at least getting some knowledge about some of this stuff, you can probably do a lot of it on your own. And then as you grow, maybe you start outsourcing a little bit or getting a little bit more advice. And then at some point you actually hire the person or the service that does this as part of your accounting team. Because if you've got a business that's making $250,000 profit, bottom line, take home, seller discretionary earnings, whatever you want to call it, you probably have, hopefully, a bookkeeper in place, and you have someone who's filling that managerial accountant role, who's doing forecasting and projections and budgeting. It may be you as the business owner, right? This was my dad in his business. He spent a lot of time creating and looking at spreadsheets of, if this happens, then that is the result, right? That's managerial accounting. That's looking forward. So just like that, you've got your financial accountant who's backwards looking and preparing your profit and loss and things like that. And it's at that point that you can add a tax strategist to that team to help you with it.
Right.
And I think this is a really good example, and something that I've been talking about recently is, generally speaking, if you own a business, if there's a job getting done that someone else isn't doing, you're doing it as the business owner, right? So you could be the chief salesperson and the chief marketing officer, but also the janitor and the receptionist and the social media content manager, right? If those jobs are getting done, you're doing them, great. It's the same with accounting, that you're your bookkeeper, you're your financial accountant, you're your managerial accountant if you don't have somebody else filling those roles. The interesting thing with tax strategy is that's often a role that just isn't getting done in the business.
Oh yeah.
Right?
Oh.
So it's not like you can get this off of your plate and have someone else do it because it's taking up your time. Usually it's just the thing isn't getting done at all. Right. And that's the scary part for me, is you can ignore it for so long because you're focused on doing other things. Maybe you're focused on growing the business, maybe you're doing your bookkeeping, whatever it is, but at some point you're gonna find out too late that, oh my gosh, this planning thing, this proactive tax planning thing wasn't getting done, and I got crushed last year, and now we're a third of the way or halfway into this year, and I realize I got to do something this year, right? Yeah. So I think that's the important thing, is even if you don't work with a professional early on, at least getting familiar with these concepts and topics so that you can do some stuff on your own or on a limited basis with a professional, as opposed to hiring them full time, can make a huge difference.
Right. I think too, really focusing on tracking, even if you aren't making that much income to the taxable income line. I think focusing on the expenses that you are, accruing, things like mileage, things like the little things like the receipts, making sure that all of that stuff is really tracked so that you're catching every possible deduction is really important.
That's a great example. Like it reminds me of that time that we went out to dinner with a client a month or two ago, and he paid, and we were getting out of the restaurant, and he threw the receipt in the trash. But you're his tax strategist, so you reached in the trash and grabbed that receipt for him. Like, yeah, you can only write off 50% of this, but hey, it was a decent meal. Like that's the equivalent of throwing out a $50 bill there, man. So yeah, I think that's a good example of like a good, you want good foundational tax strategy. Track your expenses properly and account for them properly, and that's where the bookkeeper comes in and can really help, because they can streamline that process.
Yeah, that's key to knowing where you're at, when you're going to need some more strategy, and that's really important when you are like growing and you're at that point where, hey, maybe I'm still a Schedule C. Knowing and having bookkeeping in place so that you know that you're at a place where potentially electing an S Corp strategy could cover a payroll for you, and reduce a big thing that a lot of the small business owners see of that terrible self-employment tax.
I had that question. Why does an S Corp save me money? Like, how does that save me money in my taxes?
So I'll start with before an S Corp, what life is like. Right, and we have this with a couple of our businesses, just because it's the way that it's the way that the businesses operate. It makes sense for us. But let's say you have a job even, and you set up a side hustle. I don't know, cleaning houses or doing social media marketing, or I don't know, building and selling furniture. Right. Yeah. Most people are either gonna like do that in their like just pay me cash or pay me in my name. Or maybe they set up like a fictitious name, or they can even set up a limited liability company, like an LLC, and get paid for that work, right? And if you do nothing else, you get that income, maybe you have some expenses, and that shows up on what's called Schedule C on your income tax return. So it's on just
your personal return.
Okay. So it's your Form 1040 Schedule C. It's a sub part of that Form 1040. So that's the general rule, and on that income, you're going to pay income tax and Social Security and Medicare and what they call self-employment tax. So it's going to be at a certain rate. So Jackie, if you can explain to us when it's appropriate, and it's not always appropriate. Not every business can do this, but this is like, we do have clients. We were talking about a client yesterday that like, this guy makes how much, and he's still on a Schedule C?
We've seen a lot. Yeah.
So people don't know. I at least twice a week get that question of why does this save me money? Should I be doing this? I'm like, I believe so.
So explain how it works. So if you set up an S corporation, what does that actually mean?
So if you set up an S corporation, you are effectively identifying your business as a separate entity, a lot more than when it was just an LLC, right? So you respect all the corporation rules that are in place around it. And so as a result, then your work in the business needs to give you, or you should be getting from the business as a result of your work in the business, a reasonable wage.
Yep.
You will get paid a paycheck for what you are doing in the business. And that is then considered your employment, right? It's no longer self-employment. There's a separate entity. You're not self-employed per se for reasons of taxes. And those taxes are going to be limited. Your employment taxes will be limited to the amount that you are paid from the corporation. An S Corp is a pass-through entity. So then any of the income then that is over and above what you're paid and your expenses.
The leftover profit, basically.
Right. Your remaining profit is going to come to you as a shareholder in the company. And it is taxed without this self-employment tax on top of it. Mm-hmm. So when you make enough in your LLC that can become an S Corp or PC, maybe that's a whole nother discussion about C Corp versus S Corp. But when you make enough in your LLC to give you a reasonable wage paycheck, then we can say any of this profit over and above your paycheck is not self-employment income. Let's go for this S-Corp election. And so with that, you don't pay self-employment taxes, which is FICA, right, and the Medicare tax. Now, the FICA tax does level out at a certain number, which incrementally changes every year, right? But the Medicare tax keeps going. So even if, let's say, your reasonable wage is over and above the FICA limit, let's say that's the case.
What do you know what the FICA limit is?
I don't. Off the top of my head, I don't know what it is for this year. It's 160. It was 168.
I was going to say it's 150 something, but yeah. That's right. It was 168 last year.
Yes.
That's right.
Okay. So even let's say you make
168,000. Let me make that clear.
Yeah.
So.
Not 168.
Yeah. Right. Sorry, I take the 3 zeros.
We tend to ignore.
I knew.
zeros
I knew you meant. I'm like,
okay. So even if like you have a profession or you work in the business that if you would replace your position with someone else, you would pay them $200,000. Any income that the business makes, or any profit, that the business makes over that $200,000 is still going to have some level of tax applied to it. Mm-hmm. So, we like to see that if you can pay yourself that and there's going to still be more, we want to limit the amount of self-employment tax that you're going to be paying. Trying to think of what other parts there were to your question, but that's
the example that we use is if you've got an LLC that isn't an S corp, or if you're a sole proprietor. Right. And this is an oversimplification, but if you make $250,000 a year, you may pay $47,000 a year in taxes.
Yeah.
Well, if you make that S corp election, it's not a separate entity; it's just a tax election that your entity makes. You can reduce your tax bill to about $35,000 a year.
Yes.
So that one move could save you $12,000 if you're making $250,000, and the benefits continue to accrue from there if you're making even more. So
and it's an annual thing too. It's
every single year.
Every year you're saving that difference.
And it's eliminating it. It's not like not like putting money into people put money into their retirement account and they think that's tax planning. That's tax deferral. But when you take that money out when you retire, you're going to pay taxes on it, right? So you're kicking the can down the road and you're gambling on whether your tax bracket or your tax rate is going to be higher or lower than, or maybe you're taking the risk of maybe at some point you can convert that retirement account into a different type of account. But with the S corp as a foundational, like setting up your entity properly question, that eliminates the taxes. Mm-hmm. They don't come back. They're gone forever.
Right. Year over year.
And that for me is like enough to have this discussion. But then the other cool part is having that S corp set up gives you so many other options for S corp for deductions that you can take and strategies that you can have. So I was listening to some influencer the other day, tax influencer on Instagram, and he was at an event and somebody came up and said, "Oh, what's like the one strategy that independent contractors should look for if you're a 1099 contractor?" And this guy goes, "Oh, you should look at the Augusta rule." And all I can, you made the same look that I did. If you're a 1099 contractor, unless you're set up as an S corporation, you can't do the Augusta rule. And a lot of 1099 contractors are not set up as S corporations. So that's why we like to start with the entity selection, and we review it annually, and we review that salary calculation annually because things change and it can get screwed up. But let's take a step back from the tax piece of that, because I think there's an important lesson to the concept around the S corporation that not enough business owners understand this. You get paid for working in your business as if it's a job. Mm-hmm. But as the owner of the business, you should also be getting paid as the owner of that business.
Yeah, as a shareholder. Yeah.
As a shareholder, as an investor. And I think so many business owners think, well, I'm making enough money to support my lifestyle, but they're working their butts off. And I think if you can make that mindset shift of, you're invested in your business, right? You needed startup capital, or you've put your sweat equity into it, or you've emptied out your retirement account, or whatever it is. Like, we've all invested in some level into our business. I should be getting a return on that investment. Mm-hmm. And then on top of that, for the work that I do in the business and the job that I do, I should be getting paid for it.
I had someone call the other day and they said, my accountant says that doesn't pertain to me. I can't do that. Would be a reason?
An S-corp election?
Yeah. Why would be a reason?
That's a fair question. Let me first address how horrible that advice is, because we've heard that conversation, but then let's get into the truth of that advice, right?
Yeah. I mean,
what drives me crazy with this stuff is people say, is this a write-off, or is this a deduction, or is this strategy applicable to me? And most accountants will say, no, you can't do that.
Yeah.
The better answer is, here's how you can do that.
Okay.
Let me give you advice on how to make that work for you, and then you can decide whether or not to do it. So for an accountant to say, no, an S-Corp doesn't apply to you. Well, if it's going to save you $12,000 a year, plus open up the playbook on all the other strategies, why don't we work together to see if there is a way that an S-Corp can be applicable to you?
Right.
I mean, are there rules that
there are rules.
Every LLC be able, or is it that's not the case? Not every
not
LLC.
Everyone can.
Okay.
So Jackie's going to love this question because this is so rules driven.
But I think it comes down to timing. I think there's a lot of reasons why someone might say to say this doesn't apply to you is too broad of a brush, right? I think there's a lot of ways that when does this apply to you? Mm-hmm. What do we need to do to get there? Like you said, how do you make it work? But like not just like, oh, this will definitely work for you. Like,
right.
I think with anything, like ask about the strategy. And then if they're not coming back to you with other questions to qualify you through that, then you're not getting strategy
Should be a
advice.
red flag.
You're getting an answer to an email.
So one example that I would think of is, like, let's say you're a graphic designer, right? And you do work on Fiverr or Upwork or whatever, and it's just you and a computer, right? It's really hard to make a case that there's a separate business there, which is what you're trying to do with an S corporation. With an S corporation, you're saying there's a business that generates a return for me as the owner of the business, and then I work this job. But if I'm a graphic designer and I handle everything, I've got no team, I've got no staff, I've got no systems, it's really hard to make an argument that the profit that the business generates is separate from the work that I do. They're not two different things.
So you have to have employees?
That's one really good way to do it. I believe with technology, there's other arguments that you can make that if you've got systems in place, even without a team. But that's the whole point is, we get this with realtors all the time. Well, if you're a solo realtor, it might be difficult to set up an S corporation. But if you can grow a team, or you get an appointment setter or someone who's handling your transactions, or you're working with other systems and things like that, you might be able to make that argument. So I think an oversimplification of that rule, Jackie, and you can disagree with this or supplement it, is you've really got to show that there's a business separate from you. They've got to be two different things. Right.
So it's a separate entity, like we talked about before, right? So it needs to be able to survive without you. It's not like just an extent, like it's not just like your right arm or your, it's like it's got to survive with. Like
it should be able to run. Yeah. If you weren't the one doing all the work. Got it.
Yeah.
Okay.
All right. So let's talk about another one, kind of changing gears here a little bit. I think we were crushed at the end of 2024, like the last 30 or 45 days of the year, because a bunch of people were scrambling with ideas, right? Or questions, or what can I do now? And like we started at the top of we started at the top of the show, your life will be easier and you will save more money if you start now and not in October, November, December. But we do have people that ask us, like, hey, what should I do about making big purchases? If I want to, can I time it if I want to buy a car or a piece of equipment or a piece of machinery, or maybe even buy a business? Like, is there a rule of thumb, or is there a guideline or a benchmark that you can give people of, like, the best way to time big purchases?
Well, I mean, I think everyone should remember, too, a lot of these things we're going to invest in, in order to get the tax benefits, especially if it's depreciation heavy, is that you need to put it into service before the end of the year. And this, even if you have a tax strategy, even if you met with a planner and you have a plan that is like, okay, we're going to buy a vehicle, please don't buy it on like New Year's Eve. Okay. Like, if you knew that you were going to do it, like, you want it for the tax savings, and you need it for the business. Like, okay, first we need it for the business, and then the tax savings. But don't wait to the very end. Like, it looks only like it's being done for tax savings.
Because the date matters. This is a strategy where a date they look at matters. Like, hey, know what you did here.
Yeah, so like people think they get cute because they're like, oh, I'm going to go and buy a whole bunch of extra pencils on December 30th, and that's going to reduce my tax bill. Or that's when I'm going to buy the computers and laptops. And like, fine, whatever. Things, it's such a small amount. Like,
those are okay.
If you think that's actually making a difference in your business, I guarantee you're missing out on a bunch of other stuff. But let's use the car example. But this can be true for machinery, equipment, any other big purchase. you need to make the purchase and place it into service by December 31st in order to get the tax benefit that year.
So not buy it, put it into service by December 31st.
So not like exchange the cash. It has to be placed into service.
Here was the game. And there's some news on this that came out last week. And Jackie, you and I haven't even talked about this, but it sounds like they're bringing bonus depreciation back to 100%, back to January 1st, 2025. So even though we're 5 months past that, or 4 months past that, we think they're going to bring it back.
It's not at that now.
No, it's 40% right now.
Oh, wow.
All right.
Okay.
So here's the game that people were playing when we had 100% bonus depreciation. And I call this a game, but this is a game I like to play. There was a rule, I'll oversimplify it. There was a rule that if your vehicle weighed over 6,000 pounds, you could write off 100% of the business use of that vehicle the year that you bought it. Yes. So if you've got you go out and buy a Suburban, an Escalade, a Sprinter van, whatever, weighs over 6,000 pounds, GVWR. If you buy it and place it into service by December 31st, you can write off 100% of that vehicle that year. But think about this. I can fill out the application and pick out that car in November. I can take delivery of it in the middle of December and start using it in my business. My first payment won't be due until January 15th of the following month, right? 30 days later. So I can buy this, take delivery, place it into service, write off 100% of it,
and not have to.
I haven't written a check. A penny has not left my bank account for this until the following year. So that was the game that people were playing for years on this. Is like that was a really fun, cool move. Now, in my opinion, if you did it in April or you did it in July, like it's not as cute, and you still have some cash outflow that year. But that's what you could do. So if you were nearing the end of the year and you still hadn't done enough planning and you still wanted to reduce the tax bill and you actually wanted to buy a new vehicle, because it's horrible advice to tell people to spend money they weren't already going to spend just to save on their taxes, that was the game people would play. And it's coming back. And then that 100% went, a few years ago, it was Tax Cuts and Jobs Act. It was 100%, then it went 80, then 60, now it's at 40. Now it's at 40. Ooh. But they're bringing it back because the content on social media is all about go and buy the SUV and write off 100%, but it also applies to machinery and equipment and stuff like that.
So it's not just a car.
So it gives you an incentive to invest in your business, which is one of the things the government wants you to do, and that's why tax policy is effective on stuff like this. So and then we can get into race cars and airplanes and other cool stuff too. But that's the point of, like, it gives you a reason to invest. The other thing I like about bonus depreciation is when it comes to real estate investment. So another thing that we hear people talk about a lot is doing a cost segregation study.
Yes.
So Jackie, you want to give us a little bit of an idea of what that is or what that even means?
Yeah. So the idea of a cost segregation study is this is more of a deferral strategy, right? What this does is that it brings more of the depreciation to the front of the purchase of the real estate. So real estate, depending on the type, is normally depreciated over 27 and a half years or 39. When you get a cost segregation study done, you are able to accelerate based on the components of what is in that structure, right? So
they do a study and say, here's the stuff that you could depreciate over 27 and a half years, which is the general rule.
Right.
But here's a list of stuff that you can write off faster than that.
Right.
Because and I think what some people don't understand is, well, if I buy $1 million property this year, I can write off $1 million on my taxes.
Yeah, you can't do that.
The IRS says, no. You can write off a fraction of that every year for 27 and a half years. That's the general rule with how depreciation works. So that's a big misunderstanding.
Right.
So, cost segregation study. How does that, do you have to do that when you buy the property so that I can save the money this year, or how does that work?
No, you can actually elect to change an accounting policy and do it in a year after you've already purchased it. The idea, though, would be, you don't want to go too late after having done it. But so that's a tax deferral strategy, helps to bring the savings to the front of the purchase.
So that's another one, that if they bring back bonus depreciation, cost segregations are going to become even more beneficial to people.
Right, exactly.
And the cool thing is, if you already own the property, you can still do the cost segregation now. Now, the timing may matter, and you may decide whether or not you want to do it. But this is a great example. We see clients that have significant tax bills that, if you follow the rules and if you do it properly with real estate investments and cost segregation, their tax bill can go to zero.
Yep.
So we
like
playing that game. All right, so we got into some good stuff today. I think it was a good sort of refresher course on tax strategy and what people should be looking at. This is your friendly reminder on May 7th to be worrying about your 2025 taxes now. Have a great week, everybody. I believe in you. Jackie, thanks for being here.
Yeah, thanks for having me.